Hello friends, this is Rajat Dhar from Finogent, and as we know that as we have entered into 2024 and the markets have been at the all-time high except in the first week of the Jan, and obviously backed up by the very exuberant results that had come for the state elections, which obviously point to the fact that BJP most probably would be coming in the general elections result and again forming the government. Having said that, there has been a sense of euphoria into the market, and FIIs are also pumping in money along with the DIIs. But now the crucial question arises. There is a point where, at this moment, every time it happens, there is a tendency in the investor which is called as the recency bias. So recency bias means if the market is falling, 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 and falling, everybody will be withdrawing the money because they will be seeing that market is going to fall because recently that is the trend that they have seen. However, currently, if we are able to see in the last 3 months, everyone has become bullish. The stock might have got doubled or tripled, and the people are again investing in the same stock, which has become twice or thrice its share price without equivalent increase in its own economic value or the net profit or all other parameters. Which brings us to the very basic point key, because our portfolio doesn't have just one asset class. It has mutual funds, it has bonds, stocks, golds, and all. So if we see this scenario, and obviously as an investor we have seen that people, whenever they invest in mutual fund, the first thing they look is what is the past performance. However, it is already said that you don't need to look at the past performance, and there has been a research done in 1986 and again reiterated in 1991. We said that 90% of the impact on the portfolio is due to the asset allocation and not the selection of the securities. However, other factors like timing, amount, charges, all that get factored in. But however, 90% of the reason of that is asset allocation. Now, today I will be going and showing you the data for the last 11 years, how a portfolio which has certain proportion of fixed income stocks, mutual funds have fared. So if we are thinking that the market is on the bull run and we know that the equity is going to give returns, what we will also have to see how the portfolio as a whole, commensurate with all the assets taken together, has performed, and which combination has given better returns over different periods over a 1 year returns. So with this, I am sharing with you the screen, and here we are. So here we are into the asset allocation part. So it's all about aligning the investment with the economic variations. So what we are actually doing, we are actually aligning our investments. We want to align our investments with the economic variations, because so that we want to invest, if it is equities, we want to invest into those places where the government is actually having a focus upon, or where the corporates are sending their money, or which are the sectors that are the most favorite going on. So therefore, asset allocation is a strategy which we use to align our investments with the economic variation. Having said that, we have to see that like I already said, that 90% of the impact on a portfolio is because of the asset allocation. And the impact, how two different funds will interact with each other, or how two stocks will interact with each other, asset allocation impact is not more than 40%. So asset allocation will not tell you how one fund will behave as compared to the other fund, but yes, it would say that there will be a greater standard deviation and there could be an impact on the portfolio as a whole, rather than two similar stocks into the same asset. Having said that, normally we know that in globally the subse, what we say, there's the most common type of asset allocation is 60-40, 60 equity and 40 debt pans out. And also then we have this what we say, that asset allocation 2, which has a touch of gold. Now here we have equity, here we have debt, but what we have done, we have uh, increased the equity part and we have increased the gold part, we have reduced the debt. Similarly, as we go down in different asset allocation, we have reduced the equity exposure and we have increased the debt exposure and we have increased the gold exposure. Now we will have to see that how these type of 7 asset allocation have impacted the growth of the portfolio. So if we say that, we can say that this is a portfolio 1 and this is a portfolio 2. this is a portfolio 3, so on, and this is a portfolio 7. So we will have to see which portfolio, the one with the higher 70% exposure to equity or the one with a 60% exposure to debt has been the best performer. So which has been the best performer? That is what we have to understand here. The point we have to see that your asset allocation model will be a product of how much risk you are willing to take. So diversification, what does the diversification means? It actually means, you can say both ways. It is a reduction of the risk as well as the highest return you want to have. So how much risk you want to have, asset allocation or diversification is the way and means to do that. Now, these 7 portfolios, if you see that 1, 2, 3, 4, 5, 6, 7, these 7 portfolios have been mapped across years, in terms of their returns. What was the lowest return, which portfolio had given the lowest return, and which portfolio had given the highest return. Now if we see here, we know that in 2023 the equities have done exceptionally well. That is the reason why portfolio that has the maximum contribution to equity had performed well. So this is the one thing, this we know as of now. Now let me put you in another picture of it. If we see 2013, it is again equity, 60% this and 40% debt and gold. We can put debt and gold both being conservative into the single category, and we will see that whether the equity has a portfolio is biased towards equity or not. And then we see the which portfolio structure has given the better returns. In 2014, again, equity had given the returns. However, in 2015, this was the first time, if we see in the last 11 years, the debt and gold with 80% allocation had given better returns among all these. So even if you would have the 70% equity portfolio and 20% debt, you would have been the second last, that means at the 6th rank in the returns. Again, in 2016, if we see that, again, debt and gold had been consistent return performer. 2017, obviously, again, equity came up. And 2018, 2019, and 2020, if we see that 3, 4, and 5, in these all 3 years, the equity proportion had not been even touching 40%. So it had been less, with more allocation to debt and gold in equal proportion. And then debt and gold also again in debt with 60% in 2018. Now, while we do this, we will see again in 2022, we know that the returns had not been there in the 2022 much. So that means 6. So if you see that out of 6 out of 11 years, it had been a debt plus gold which has performed better. So this we have seen. So therefore, when we are putting together your portfolio, we have to see how to maximize the returns. That is what we are doing. We have to contain the risk also, but we have also to see the how much risk we are taking to get how much return. So that means if I am invested 70%, so if you see, if I am invested 70% in the portfolio, but I am my portfolio is 6th in the rank, so it is the second last in the rank. So that means I have taken more risk, but my returns have actually diminished, which obviously we are currently in a bullish trend. We will see no, equity has performed a better return. But now what we have to see is in how many years, when the portfolio return was 70%, portfolio allocation to equity was say 70%, how many subsequent years that run rate had been maintained. That means a portfolio with a 70% allocation to equity had consistently given a better return. So if we see from that perspective, here is 60%, here is 70%. 2 years after 2 years of the bull run, we can see 20% not happening. Then again 1 year it 70% allocation portfolio gave the better returns. Then again it fell down here for 3 years. Then in 21 it again went up, 22 it again went down, then again went up. So therefore the catch is, when we talk about investing is about the long term investing strategy. If you think that you are entering afresh, if you're entering afresh at the time when the markets are the all-time high with your exposure to equity, there might be the time over the next 1 or 2 years the exposure to equity being at 30 to 50% would be a good would be a good decision rather than going 70% into the equity just on the backdrop of the expectation of the results, because that might provide a swing for months, 2 months, or a 4 months time, but eventually the prices have to be rationalized. The prices in the stock market have to be rationalized because the FIIs and other DII investors will have to book profit, and they would be booking the profit. So then there might be a lull for a couple of months before it will again pick up due to the cyclical nature of the market. So now the question is, which one should investors select? The first and foremost is, it totally depends upon the investor type. So if he's a risk taker investor, he can go with the 60% equity and the 10% gold also. Now here one thing is to be seen, that portfolio with a 10% allocation to gold has already given a better return as compared to gold being zero. So even if you are an aggressive investor, it is more prudent for you to go 70% in equity with 20 and 10% allocation to gold and debt, rather than going 30% into debt totally, because the returns in this are more optimized than in case of the aggressive investor one. So now we know that in case if I am a conservative, I can still, or we can say a balanced type of investor. I will more so say it is a balanced type of investor rather than conservative. You can go 50% into equity, and then you can go 40% into debt and 10% into gold, or you can increase the gold allocation and reduce the debt allocation. But then obviously it depends upon your debt is long term debt or it is a short term debt. Interest rates are going to go up or go down, because that will impact the yields. So therefore, based on that parameter, you can decide what allocation you want to keep into debt and how much risk you want to take. So if I say that Sensex is at all-time high, Sensex is at all-time high, and the rates are going to go down. So therefore, long-term bonds yield will increase. So even if I reduce my exposure to equity, but I increase my exposure to the long-term bonds, I will still get, you can say, I can still get double-digit returns, provided I have the gilt funds, as it has historically been seeing that double-digit returns in the falling interest rate scenario in the gilt funds or the long-term government bonds for a maturity of around 6 to 7 years had been seen. So but actually it all depends upon investor to investor. Now if you are an investor who wakes up every morning and checks the portfolio every morning, if you wake up every morning and check the portfolio, kindly go on the conservative side, rather much lesser exposure to equities. So therefore, looking at the portfolio every day is not a wise thing from the portfolio perspective, because even if in the shorter term you keep on rebalancing again and again, it will really what do you say, that it will actually backfire. The only consideration in which you can rebalance the portfolio in the short term would be when a portfolio returns are, say for example, 25% or a 30% in total. In that case you can rebalance to it at the original asset allocation level, so that because over the longer period in the time, 20%, 25% of the portfolio return will actually normalize to a 15 to 12% rate of return. So therefore, if any year the market has exceptionally gone high and my equity portfolio has given 40-50% return, taking my average return of the portfolio to say around 20 or 25%, then what I could do, I could rebalance the portfolio again, reduce my equity exposure. Whatever the profit has been there, I can put it into the debt funds or gold funds and then rebalance the portfolio. This would serve two purposes. First, whatever the profits had been there, I have secured those profits, so the probability or the odds of market going against my benefit will not be there, because I have already taken into consideration the risk mitigation strategies. So there are the two factors to it. How much is too much? Because nobody can time the market. So if tomorrow the market falls by thousand points each in the next 3 sessions, on the fourth session you will say, no, 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 I can't come out of the market. The market is already corrected by, my portfolio is corrected by 8%. I cannot leave 8%. So with that, you will be stuck with the portfolio for the next year or two by the time the portfolio recovers. Now, having said that, on that perspective, so what can an investor do? The first and foremost is there has to be a strategic asset allocation. Now, we know that the fund's performance will get impacted over time. It should align with your risk tolerance and investment horizons and financial goals. Don't go into the investments if your horizon is not 5 to 7 years. Go simply for fixed deposits. If you are not willing to go beyond 5 to 7 years, don't invest into the portfolio, even if that is a long term bonds. So in that case, you can just go to overnight funds or the liquid funds or the short term bonds. Even if you want to explore, the shorter, less riskier assets for that matter. Second thing is diversification is the key. So we know that the asset allocation does not explain the variation among different funds. It cannot tell you why one fund, how one fund will react with the other fund, but it will actually show how the variability of the returns of the portfolio would be impacted. Third is there, you need to have a long-term perspective. You can't do frequent changes. Frequent changes will not be effective. It's as simple as that. It's as simple as that. You are not a trader, you are an investor for that matter. Then there is a role of other factors. So it could be the timing. While the asset allocation is crucial, factors like stock selection, whether you have entered into the right stock or you have entered into the right sector, what has been your timing, when there had been a selling signal, then you have entered into the stock, or when there had been the buying signal, there has been increasing the interest rate scenario or a falling interest rate scenario, and you have got into the banking stocks. So that will also impact your portfolio. So asset allocation while uh, asset allocation while accounts for 90% of the impact, but there are many other factors that fine tune the returns that you would be having, so that you don't have to wait too long for the better returns. And if you invest efficiently and with the good timing and the price points, not buying the stocks or the mutual fund at the high, but rather averaging it out over a rupee cost averaging standards, so then that way it will be much better and much optimized returns for that matter. So therefore, if we see that one thing is for sure, 70% equity exposure has not consistently given higher returns on year basis if we see the last 11 years. So 6 out of 11 years, that is more than 50% of the time, it had been debt and gold, debt and gold. And obviously, if there had been one or two successive years where the equity exposure of more than 50% had been in the portfolio, the average portfolio returns had been higher. But once those 2 years have passed, the third and the fourth year, or third year had been predominantly at debt portfolio, had predominantly been at debt and gold oriented portfolio, that has given a better returns than an equity biased portfolio. So therefore, you need to see how you need to align your portfolio, and just don't jump on one fund or the other, just be seeing their recent performance for that matter. Thank you so much. This is Rajat Dhar signing off, and have a great day. Thank you so much.